the market is very volatile in the short term. And that's why I think it's important for us to keep that long-term mindset and yet still pay attention to the data and the noise in the market on a day-to-day.
That's kind of where we come to. Last part of this is predictions for 23. We always like to give a little bit of what may be, what we may expect. And I know Kyle and I have talked offline a little bit about, the old, he calls it 2 steps forward, 1 step back. I call it, bumping around, where, 1 month looks great and the next month everybody changes their mind a little bit. And the next month, oh no, inflation's coming down and the Fed's not going to raise rates as much as we thought. And then the next month, probabilities go from 3% to 71%. And so you see a market pullback. So, but that's mine for 23. I think we're going to see a lot of up and down, where maybe you end up, 5-6 months down the road and you don't feel very far ahead from where we started. But again, it's very difficult to time the market because, as somebody once said, when's the market bottom? You wait until it happened and then you say, oh, that's when it was about 6 months ago. That's the best way to determine.
Well, I like you said, Adam, we talked about it, so I'm kind of in the same camp, and we've been looking that way for this year, is that it's at 2 steps forward, 1 step back. Everything's going to be reactionary to news and data, and maybe not even data, just words. What is Jerome Powell going to say next? Is it, is he going to be dovish? Is it hawkish? Is it going to be, aggressive rates or slow down on the rate hikes? And is inflation going to go from 6 to 3 or 6 to 5? So I think it's going to be reactionary, and that's what we've seen the last couple of weeks here towards the end of February. So we had a great start to the year, and now all of a sudden we had one little misprint in the inflation number, and it's like, well, maybe they will keep raising rates longer, and so we better take some profits. And so the market is very volatile in the short term, and that's why I think it's important for us to keep that long-term mindset and yet still pay attention to the data and the noise in the market on a day-to-day. But that's my theory too, that it's going to be one of those 2 steps forward, 1 step back kind of year. What will determine whether that's a positive or a negative at the end is a lot, out there still as far as what that inflation number looks like. I think if that inflation comes down below 4-5%, then I think we can have a positive year. But that's kind of where we're at right now, is that 2 step forward.
How about the fact that most time people probably couldn't even tell you who the Fed chair is, and now they're like reading his facial expressions.
Did he say it this way?
Did he say it angrily, or was it like softly? How did it really come out? So
yeah, Greenspan, yeah, irrational exuberance. That was one of the most popular phrases for a while.
Irrational exuberance.
Yeah. Well, volatility is, the VIX, which measures market volatility, is in the low 20s again. I mean, I don't hear many people talking about that, but it is way down from where it was, mid to late last year, and in a very sort of long-term normal range. That may be the upper part of, calm markets, but it's definitely calmed quite a bit in the last 6 or 8 months. So they tend to peak when things get really crazy. But yeah, I mean, VIX is in the 20 range right now, and so that just indicates that the volatility is down, generally speaking, from where it was at crisis times. But that's going to determine some of what happens with the equity markets too.
As far as if we're doing kind of general fund predictions or whatever,
S&P price target.
Here's kind of what I was looking at and stories I tell when it comes to stocks and bonds. And now, I had a brand new client, educated, smart person, but never been involved in this stuff. And recently retired, 401k, just kind of put away. And then we're starting the relation. They said, okay, so now that we're getting this thing going, so your job, you're going to call me before the market goes down, right? And then we can get out. I'm like, I don't know if you know what I do, but that's not it. I might have a crystal ball on my desk, but it doesn't work. And so I said,
a little foggy there, huh?
And very serious. This person said, well, why not? I thought that's what you folks did, is that you were able to, because you do this every day, you have insight as to what the market direction is going to be in a very short-term matter. And I said, the complication predicting something like that, even if we had all the information, I mean, just to get market direction, you would need to know off the top of my head what Putin's going to do, President Xi is going to do, Biden's going to do. You would need to know what oil is going to be. You would need to know what the weather is going to be. You would need to know what inflation is going to be, interest rates going to be, and 1,000 other things I'm not thinking of to even get close to what the market might do, because there's thousands of factors that formulate into that.
Well,
And
in
then
emotion, right? Aside from just actual events and things that
Aside
happen,
from
just
data.
people's
Predict general
reactions.
human emotion 6
Yeah.
months from now. And so obviously that's not something we can predict in any term, short or long. And so then started to look then into, just market history. We've never gone through anything like this before. I'm getting tired of these 100-year events, whether it's, COVID or bond markets or whatever, but it seems like we get a 100-year event right after a 100-year event. Now here in California, we're going through a 100-year event of rain. But it's 100-year event after 100-year event. But I tie this back into bonds. And so a common conversation I've had with clients around the bond market, this thought process of bonds were kind of our safe money, our safe asset, and the rug got pulled last year. And so clients wondering, okay, interest rates have been high and higher before. Why didn't bonds drop like that before? Did the quality or the confidence in bonds change? And I described to them and I explained, no, absolutely not. It really comes down to math. And I'm sure you guys can jump in and opine on this a little bit better. But basically what I explained to the client is like, okay, let's go back 40 years ago when interest rates hit their all-time high into the high teens. And prior to that, in the 70s, I'm not sure exactly what they were, but let's say they're like 7, 8, 9%, something like that. So I said, now think about in that point in time, what did interest rates do? They doubled. They went from like, let's say 8 to 16, 9 to 18, something like that. Now what we just went through prior to having the worst year in bonds ever, so let's just go back, since 1776. But what also happened just prior to that? Interest rates were at the lowest they had ever been. So then when we saw a 10-year treasury go from 1.5 to 4.5, that wasn't a double, that was a triple. So it really just came down to math. It was a 3x move instead of a 2x move back in the 80s. And so that kind of violence in the jump in rates is what caused bonds to go down. But now looking at it, now coming back to it, if I could buy a sound investment that just had its worst year ever, then I've got confidence going forward. And when I look back in bonds previously, and I went back, solid 75 years, we've never had two bad bond years back to back. Usually cooler heads prevail. The interest rates are higher on the bonds and money comes in. So I think bonds might stabilize a little bit this year. I don't think interest rates are going to be as violent. So that's a prediction there, is I really think bonds will come down and kind of return to the safe asset, and we're getting interest on it. The other thing, now this is a dart throw, but
Watch out, Tesla.
Here we go.
I kind of back out the Great Depression in this because 1929, before the Securities Act and really laws came in, I don't like to compare what happened in 1929 to say, well, what if again, because it's really kind of a different place in time. But barring 1929 to 1931, take that out, and since then, the stock market has never been down 20 or more percent and then not been up the next year. That hasn't happened. So every single time the market's been down 20% or more, and clock that in for the year, so far, each year thereafter was in the green. So I'm hoping the VIX stays low, volatility stays low. I'm not optimistic there. I think we'll have a lot of volatility this year, but it wouldn't surprise me if both markets, bonds and stocks, are up at the end of the year. Not a lot, but they could be both green.
And tying back to that, as far as we've all kind of talked about the 2 steps forward, 1 step back, what our predictions are for the market. We've had a lot of conversation on risk or volatility. I think one of the things we always, at least I had conversation with, I'm sure we did around the office and with clients too, even in the beginning and last year when things were down, is when things are down, it's not time to rebalance your portfolio or change your risk or get out of the market. It's when things are doing better. And so one of the tools that we have here, if you go to strongvalley.com/risk, it's our Risk software. I know we've talked about it in a previous call, but aside or along with, in partnership with your financial plan, it allows us to really determine where you are as an individual on your risk tolerance. It's not like one of those things where we throw out there, are you moderate? Are you conservative? Are you aggressive? Or moderate growth and income? And all the terms that get thrown around in the industry. It actually puts a feel from a dollar standpoint on your answers and bases off of your level of comfort in a market and with real dollars versus just, in our world, we talk percentages a lot. But in clients' world, it's dollars that have that impact, right? So if you had $1 million and you're down 2%, it's a lot feels a lot worse than when you had $10,000 and you're down 2%. The real dollars moving. So it allows us to put a dollar amount and stress test during different scenarios and where you're comfortable or not comfortable, and allows us to kind of realign or structure portfolios accordingly, assuming it still matches up with your financial plan. So just one of those other software that we have out there and tools that we use with clients and in meetings to help kind of feel where that comfort level is, knowing that markets go up, markets go down. We can't guarantee when the next one will be, but making sure that we can show that impact and what it might do on your portfolio. So
it's good. It's a good point. So we'll kind of wrap it up with that. I mean, listen, we love doing these. We'll be back in May and do it again. Maybe we love them a little more when the market's up, but maybe a little more valuable when the market's down. I don't know. Probably the biggest thing though is reach out to us individually. We're happy to talk to people about any individual questions you have, and as you can see, we use some of these questions without names, obviously on the roundtable. So if there's one person, we always say if there's one person that has a question, there's probably 10 other people that have the same question. They're just not asking it. So we try to try to answer as much as we can and talk about, the markets and the economy and what's driving. And if there's anything you want to see, we're happy to talk about that as well. You can see some of the things are a little bit off the cuff, like, the difference between a bank and a custodian. That's kind of what we went over a little bit today. And we're happy to get into more depth with that, if needed or on an individual basis. You can subscribe to our channel to stay connected, so when the roundtables are coming up. It's pretty transparent. It's middle of every quarter. So February, May, what do we got? August and October or November
Ish.
So ish. So that's when the roundtables will happen. And in between that, we do the monthly Market Matters, which if you want a shorter, just sort of recap on the previous month and what we're looking forward to that month, those are typically 15 minutes or so. But this is when we kind of all get together and throw everything out, so to speak. Again, appreciate everybody joining us. We'll be back next month with a shorter one, and like I said, in May we'll be back with another roundtable, and looking forward to a good 2023. Thanks, everybody.
thank you all.
Yep. Thank
See
you.
you all. Have a good one.